there are restrictions in the contract. Oh no. When you hear the restrictions, you've got to ask, what are those restrictions? These restrictions say, T, look here, for 5 years you can use the ship, but there are some rules. What are the rules? Please don't go to Somalia. There is a high risk of piracy. And also, look, you can transport T, but don't transport explosives. Are they telling me what to do with the ship, or is that just a protective right? It seems like just a protective right. You operates and maintains the ship, so you will still be the crew of the ship. My question here, is this one a lease? Let's go through the requirements. Is there an identified ship? Yes. Am I getting all the economic benefits of the ship? Even though I can't go to Somalia, is that a problem? It's not a problem. So, do I direct the use? Now the question, if the customer directs the use, it's a lease. If the customer doesn't direct the use, it's not a lease. Does T, as the company, determine what the ship is used for and how it will be used and when it will be used? Yes, because I tell you, T decides what cargo, when it will go, to which port it will go. Therefore, T directs the use. Therefore, this is a lease. You'll notice in the previous example with company R, which is the rice trader, the other entity controlled the crew, and through the virtue of that operation, it became not a lease. However, here, because the pickup dates and the transport using the ship is not predetermined, you have a lease, and they are doing that. You understand how these things work? So this is why I'm telling you, there will be lots more opportunities to get out of IFRIC 4. And you will have more opportunities to argue that something is not a lease. Why? Because the old standard just wanted you could get into a lease when you obtained all of the output or if you controlled. But in this situation, in IFRS 16, it's not an or requirement. You need to take all the economic benefits, plus you need to direct the use. This is the big change in the definition. And we will see many instances where what we had as leases for logistics companies, for electricity companies, I'm seeing this as a big issue. If some of the output can be sold to the general market, not to the main grid, guess what? I don't think there's going to be leases anymore. So they're going to be different situations. If the how and what purpose decision is predetermined, sometimes having control of minor operations could get you in or out of a lease. In example R, there was minor operations. Also, protective rights don't define rights, and some IS 17 leases will not qualify as leases under IFRS 16. Okay, so that's the lease definition. There's 2 exemptions. If a maximum possible period of the lease is 12 months, you have a choice not to apply the standard. So let's say your maximum possible period for the lease is 10 months, and you enter into the lease at 31st December, guess what? You will have a right of use for 10 months and a liability for 10 months, unless you apply the exemption for short-term leases. And you apply this per class of assets. Class of assets means you applied for vehicles, you applied for all vehicles. If you applied for printers, you applied for all printers. So that's available, but it's optional. The normal position is you will apply IFRS 16. You've got to go tell your auditors, Mr. Auditor, I don't want to apply the standard. It's an optional exemption. There's also an exemption for leases of low-value items. So if an asset is less than $5,000, you say, listen, Mr. Standard Setter or Mr. Auditor, I don't want to apply the standard to this laptop because I don't want to calculate a liability or a right of use asset for a 3-year lease of a laptop, even if I have 1 million laptops. You understand what I'm saying? The price must be of the low value individually. The individual asset must be of low value, not the total amount, because the right of use asset is calculated on a asset by asset basis. You understand what we're saying here? So these are exemptions that are available. Let me tell you, look, I'm going to just tell you one story. So a client here is leasing big trucks. They're telling me that's a low-value asset. I say, how come that's a low-value asset? They say, if I take the windscreen, I take the tires, I said, sorry, sir. The truck is a composite asset. You understand that? Okay. Okay, so that's the lease definition exemption. If you qualify for that, you will apply straight lining of the lease expense, if you do take the exemption. Look, as I told you, I cannot deal with the whole of lease accounting. There's a lot more to be talked about. What I'm going to do is just leave you with some next steps. I gave you a high-level overview. I got you through the definition. What I've done is, when I'm speaking to clients at the moment, I find that there's 5 things that they need to look at as a matter of urgency. The things I tell you to do is, if you're ready, look at the lease definition. Have a look at your current arrangements. See if they are leases. You understand it? So some people are concerned if there's 1,000 arrangements. In that 1,000 arrangements, yes, your liability will be significant. We've had this case where a client has calculated their liability. They came back to us and said, hey, Yusuf, can you please check whether these are actually leases for us? So check the lease definition. Secondly, find the data. If you've got 2,000 leases, find the data. Try to put it together. Try to at least collect the information. If you want to know what the liability is going to be like, or you want to do a quick impact assessment, make sure your operating lease commitment note is correct and the information that feeds into that is correct. What I do find is a big problem, because you're going to have more liabilities on your balance sheet when IFRS 16 comes into play. Speak to your banks now. Tell them to change the loan covenants so that you don't go into breach for doing nothing wrong. You understand that? So these are important things. Sale and leaseback, if you have a sale and leaseback, that's an issue. Financial ratios, have a look at your financial ratios. They may affect the bonuses that people will get, pay, etc. And transition, think about your transition now. You need to speak to your audit committees. Have the discussion now. Have the discussion. Tell them, guys, this will impact us. How it will impact. Let me do a quick calculation for you. Take this home. Take this back with you for 31st December. This is a value add you can provide to your organization. Say, guys, the standard is coming. We have to follow IFRS. Unfortunately, this is going to be the consequences for us. Key points to remember. Listen, I'm not going to go through a summary of the standard. This is going to impact most companies. You need to start looking at the impact right now. All right, so with that, I'm going to take a few minutes for questions before I go on to IFRS 15. Are there any questions on IFRS 16? Any points, things that are troubling you, bothering you? You have a question there. Somebody with the mic, please.
Assalamu alaikum. My name is Faisal. Do we have to assess our rental agreements regardless of the fact that whether we have treated them as leases or not? Like we have to have a look-through approach, like we are treating those rental expenses like rentals throughout the time. And obviously, we will be consuming substantial amount of economic benefit. Although they are in bank scenario, we have got premises and certain sort of IT equipment which are exchangeable rather, and it's not technology dependent as such.
Right.
So, do you have to
classify
them?
I'll tell you what you have to do. Regardless of your industry, regardless of the quantum, on 1st January 2019, you got a few choices. One is, I take all my leases. Let's say I have 100 leases. I can say, look here, do I want to check if these 100 leases are leases or not? This is a choice. The standard allows you to either accept the definition or go back. They call it grandfathering. If you want to grandfather, say, look here, Mr. Standard Setter, I don't want to go back and read the 100 contracts because on average, I'll tell you what, it takes 6 hours to read a contract and do a technical analysis. I don't want to spend 600 hours. You tell yours. The Standard Setter will tell you, okay, in that case, whatever you agreed was a lease, take it as a lease, apply the new definition going forward. That is your choice, step one. Then step two. After you've decided what to do, so you said, okay, I don't want to relook at the lease definition, so then you have 100 leases. You then have other two options. The standard is retrospective in both cases, right? It means you've got to go back in time and account for this as if the lease was always treated as a finance lease. So one is you can go back in time. Say, look, this lease I entered into in 2002. In 2002, what would have been my discount rate? What was the term in 2002? Almost as if you're going back in time. That's one option. That is the perfect option or the most clinical option where you go full retrospective. The third option that you have is say, hey, Mr. Standard Setter, I don't want to go back in time. The guy that was here in 2002 is gone. What I want to do is all the leases at 1st January, let me look at the remaining period and recognize the liability and the right of use asset. So those are your three possibilities. Can you avoid the standard? No, you can't. If the lease agreement is in existence at 1st January, you got those three options. And you can use them interchangeably. Okay? All right, so that's what you have to do. You can't leave it. So it's going to have an impact. This is why I've chosen to